Okay, peeps, welcome back. So today we're going to be talking about 5 reasons not to buy XOMO currently. Let's get it. So what is XOMO? That's the first thing. XOMO is the YieldMax Exxon Mobil Option Income Strategy ETF. So what is Exxon Mobil? Exxon Mobil is basically a large cap gas company or oil company that produces the gasoline that you put in your car every day. If you drive gas powered cars, if you drive electric, well, okay, you're not using gas. So, anyways, so we're on the YieldMax website. You guys can kind of see the overview and the prospectus and all that jazz. Over here, the most important thing that I want to begin with is the yield on XOMO. So, XOMO currently does not have a yield. The reason being, as you guys can see here, distribution rate is blank. That's because they have not paid a dividend out yet. So, XOMO's inception date, as you guys can see here, was on the 30th of August, which is our second reason. So I guess the first and second would be kind of a combination reason here. So since they came out with the fund on the 30th, they need time to write these options to actually be able to pay investors in the fund a premium. And as you guys can see, it's the 26th. So I believe the next payout is going to be probably around the middle of next month. So my guess is they're probably going to pay out in October. We've told you guys before on this channel, we don't really like buying funds unless they have a payout first. The exception to this would be Coney, because we didn't think that Coney wasn't going to pay out until October. We actually thought we were going to get paid on Coney this month, but that didn't happen. So, if you're like me, like us, you don't really want to invest in something that doesn't yet have a payout. You want to see a payout first. You want to see some kind of performance first, which is a good thing to have as an investor, a little bit of skepticism. This would definitely be the strategy to go with. Just wait for a dividend payout to come out and then decide whether it's actually worth it to buy into the fund or not. The other thing that we want to mention is the market cap. So the market cap is relatively small. It's only 5 million compared to Tesla's 650 million. So why does this matter? Well, the reason it matters is because when you have a low market cap, you have something that's known as there's something that's known as a bid-ask spread. So basically what a bid is a price that a bidder is willing to pay or buy a particular share. And the ask is the price that a seller is willing to sell a particular share. So with a small market cap like this, you're typically going to get a much larger bid-ask spread. And what that means is that because of slippage, because there's low volume, there's due to a smaller market cap, what that means is you could end up buying the shares at a much higher price than you want to buy them at and sell the shares at a much lower price than you want to sell them at. And if you're looking to buy on the dip and take profits on the way up, this causes a huge problem. So the opposite effect is basically what happens when you have a big market cap like Tesla. You can get the exact buy and sell prices that you want, or pretty close to it. So with that being said and out of the way, let's take a look at when the next payout's going to be for YieldMax funds, since we're already on here. So the next ex-dividend date would be on the 6th. If you're like us and you want to buy into Clip, you basically have until, pretty much today, that's it, to buy before the X date tomorrow. And then from that point forward, you could basically buy for about an entire week before the next X date on the YieldMax ETFs. So let's get into metric number 3. The next metric I want to bring up is the OPEC oil production cuts. So if I pop over here to Reuters.com, you guys can see this is a relatively updated blog here. You got September 13th, so it was about 2 weeks ago. Talks about how OPEC is basically going to cut production on oil. And pretty much what that means is there's less oil to make gas for people to fill their cars up around the world. So I will leave this in the description for you guys, but basically it says OPEC output is curbed by 2.5 million barrels per day since the start of 2023. Well, why does this matter to investors? Well, so here's pretty much the short of it. If they're cutting the amount of oil that they produce, then there's less oil being traded on the market, which means there's less gasoline to be created to be put in cars for people to drive around. So, in terms of the effects of supply and demand, if you have a lower supply and a higher demand, that typically equals higher prices. So, that's part of the reason why higher prices are being paid at the pump. And it really doesn't help that, the US is not currently, at least as far as I'm aware of, under the current administration we have in the White House, producing oil within the US. Okay. So, it makes it pretty expensive in terms of gas prices. So, there's that. Now, basically, why I'm saying this is because at some point in the future, we expect oil prices to come down. We expect production in oil to go back up when it seems like, the Saudis or whoever it is no longer going to be able to make as much money as they intended to make. And it's no longer going to be in their favor. We expect the production to go back up and oil prices to come back down. And as a result of that, gas prices will be less expensive. And what that means is the major oil companies like Chevron, Exxon Mobil, BP, Enbridge, all of those companies' share prices will come down, which means XOMO will come down. And as a result of that, if you buy in too heavily now, you might suffer from severe price decrease as a result of the underlying stock, which in this case is Exxon Mobil. So we're going to take a look at the CME. There's another metric I wanted to point out to you guys, the CME, if I can find it here. CME CL. Just type that in. I went over this chart with you guys on the S&P 500 to give you an estimate of what it's going to look like in the future. So let's take a look at the settlement prices of crude oil. So basically, pretty much what it's telling us here, based on the highs and lows and open and last prices going into the future, that basically the CME group is pretty much expecting or settling the prices at much, much lower prices in the future than where they're at now, which indicates that oil is pretty much topped out. So let's take a look at the fourth metric. The next metric would be oil. So you had oil sitting up here at the highs. You can see we had a golden cross. It bounced off this previous support area and oil took off. It doubled in price. I'll tell you guys right now, I did actually own some Chevron and Exxon Mobil, made some dividends and some profit off of it, but then sold once it looked like it was getting too expensive. And then we came back down to the support level. Now we're ramping up. As you guys can see, we got a golden cross here on the macro timeframes. Currently sitting in bull territory on both indicators. We do have a triple cross here, golden cross on the EMAs. So if you bought XOMO right now, basically what could happen with oil is you could see the price drop. You're going to get about a 33% drop here, pretty much back down to our buy levels, which is basically between 62 to about 75 bucks a barrel. That's where we want to be picking up oil stocks. Because again, oil stocks reflect as a result of the underlying, which is the actual oil prices. So if that happens with oil, it comes down 33%, basically what you're going to be expecting on XOMO. Let's go ahead and type in XOMO. So a 33% drop, and I'm not saying it has to drop this much. It doesn't necessarily have to drop that much, but it could happen. You could be seeing as low as basically what Tesla's price currently is, which is a lot better deal than 20 bucks. So the way I would play this is I would basically be buying little by little based on the dollar amount that it goes down. So maybe a couple shares at 20, a couple shares at 19, a couple shares at 18. And then the lower it goes towards that percentage target, I would slowly increase the amount of aggressiveness that I purchase in terms of shares. So, you get down to 17, maybe buy like 4 shares, get down to 16, buy 6 shares, 15, 10 shares, so on and so on. So let's take a look at the underlying stock, which is going to be our fifth reason, the underlying stock's performance and the macro environment. Again, I'll tell you guys, in 2008 to 2011, I remember when gas prices went to the moon, where I live at. They went from, I think it was like $1.99 a gallon to $4 a gallon. But then eventually the gas prices came back down. And for a little while, the gas prices went as low as 99 cents a gallon. So, if history is to repeat itself, probably going to see gas prices go from where they're at currently down about 50, 60%. Oil and oil companies and their valuations will come down. But as you guys can see on the charts here, we are sitting at all-time highs on Exxon Mobil. This is not where we want to be buying at. Okay. Basically, our first buy area would be like around this $104 level, $100 or something like that. The next major buy zone would be at like 88 to 96, and ExxonMobil does pay a quarterly dividend. And then below that, you're taking a look at maybe 60, 56 to roughly about 70 or so. Now, let's take a look at another one just so you guys can see that this isn't just a fluke. So, Chevron Mobil, again, sitting at all-time highs, although this one's a little bit lower than ExxonMobil. We'll take a look at another one that I showed you guys. This one I am actually invested in and considering picking up more shares because it's at a much deeper discount. And this is what dividend growth investors usually look for. They usually look for major pullbacks like this before buying. So this one's a little more discounted, but again, it's not based on XOMO, only ExxonMobil is. So you got about 25% discount on that one. And I think, yeah, I'm pretty sure this is the BP company. So this one's also a little bit more heavily discounted. But again, ExxonMobil and Chevron are US-based companies, and they're extremely expensive right now, especially ExxonMobil. If you guys are looking to pick up XOMO, you can do what you want with your own money, but if it was me, I would be slowly, very slowly DCAing into this after I see what the dividend payment is. Regardless of what the yield is, doesn't matter. And just simply because of the fact that eventually gas prices and oil prices are going to come down. And do you really want to pay a 33% premium on something that you could get for a cheaper price? I personally wouldn't. So anyways, hope you all enjoyed this content. Please like, comment, and subscribe. And we'll see y'all later. Peace.